You're watching the Retirement Halftime Show. I'm your host, Alexander Joyce. And with me today is Tim Ayers. We are still talking about mortgages. We've done a pretty good series on mortgages. And I think that, as we end this series, we'll talk about different things like non-traditional uses for a mortgage, like cash out refi. We're going to touch on things like reverse mortgage and different topics, right?
Yes.
Because it's a loan. And these houses and these homes that we take this loan out for are assets. Right. I mean, these are real tangible things, and what ways to get in there and take some of those monies out as we mature, perhaps in retirement or in life in general. What are the better ways to do that as opposed to just liquidate it, sell it, move on, right?
Exactly.
And so we'll touch on that as well. But today we want to talk about USDA, right? We've talked about conventional, FHA, and VA. Right. And so now we're going to jump in both feet, Tim, at USDA loans. Who are they for? What are the purposes of them? How do they work?
Well, USDA, they're for people that want to live in rural areas.
Okay.
And you don't have to have a USDA loan to live in a rural area, obviously.
All right.
And they're not necessarily for farmers. And that's what people generally think. Well, it's a USDA loan, there's got to be some stake in there somewhere, right?
Yeah.
Well, no, that's not the case. USDA is for anybody that wants to live in a rural area, and it is defined by a map. And I'll give you that website. But the requirements are basically the same as a conventional mortgage, and there's no real loan limit. There is zero down again, and the PMI is reduced, or it's much more affordable than an FHA loan. So you have all of those things going on. Also, the interest rates tend to be a little less, a little lower, because again, it is a government-funded or government-backed loan.
Sure.
And so that makes the process a little bit different,
a little easier.
Okay. But there are income limits.
I see.
And one of the things that I found most troubling with clients is that they didn't realize that if their daughter or son are age 18 or whatever and contributing to the household income, we have to count that income.
Household income.
So it's total household income.
I see.
Complete.
I see.
And so that has been a little bit of a sticky wicket in a few places.
Okay.
But generally it's workable.
Cool. I think that's a powerful takeaway, because I could gift my portion of my land to my son. He lives in the home. I no longer farm, but we run the family farm and LLC out of my son and his business. That is considered household income, right?
Yes, any income,
right?
Any source of income.
I'm a strategic thinker, right?
Wow, that is
right?
good.
And that's what you want, right? I mean, that's what people want. They want thinkers outside the box, non-traditional finance, right? But listen, I think I appreciate that, Tim, and I think that I've learned a lot every time we do this, and it's good to have a relationship like this. When you walk in our building and you walk in our firm, we answer tax questions, estate plans questions, mortgage questions. It doesn't matter what it is. Call it holistic, right, Tim? But I think that it's very important to have people designed, dedicated for that purpose. We have these questions every day. And so again, folks, stick around. You're watching the Retirement Halftime Show. There is more show to come. The best is yet to come.